Welcome back to the Main Street Money Podcast. I'm Andrew Gay, along with Zachary Green and Gilbert Pies, and we are the Texas Hill Country Advisors, independent financial advisors based in the beautiful Texas Hill Country. Wow, what a week. The S&P 500 and the Nasdaq both hit all-time record highs this morning. This is Friday. We're doing this on Friday in the week, May 1st. Happy May, everybody. It was their best monthly performance since 2020. The Fed held rates, of course, but the vote was a dramatic 8-4 split. The most divided FOMC has been since 1992. Jerome Powell held his final press conference as Fed chair and pledged to stay on board until an investigation into the Fed is, quote, well and truly over. Q1 GDP came in at 2.0%, a recovery from last quarter, but below expectations, and PCE inflation, the number that the Fed prefers to watch most closely, surged to 4.5% on the quarter, even though I think the core number was a little lower than that, but it was still quite elevated. Oh, and Apple, Alphabet, Microsoft, Amazon, and Meta all reported earnings this week, so there's a lot to unpack. Let's jump into it. Any starting comments before we jump into the craziness of this week?
Well, I think the announcement from the Fed this week about not raising interest rates and Jay Powell's final news conference was probably the most impactful thing that happened this week. They didn't really lay out the course for interest rates for the rest of the year, but I think if you read some of the details that came out of it and listen to that news conference, seems pretty clear that they're not going to be doing much with interest rates for the rest of the year.
Yeah, so let's start there. So Powell's final Fed press conference. The FOMC voted 8-4 on Wednesday to hold rates at 3.5 to 3.75%. That's their current range. They've been at that for a while. This is the third consecutive hold. The last time four FOMC members dissented on the vote was October of 1992, extraordinarily rare level of division within the Fed members. 3 of the 4 dissenters voted to remove the easing bias from the statement, signaling they do not want to signal for future rate cuts. One dissenter even voted to cut rates, seeing growth risk as more pressing than inflation, which was kind of interesting. And the 10-year U.S. Treasury yield hit 4.41% Wednesday, markets pricing higher for longer. And that is not a new story. We've talked about that on here before. I feel like we've talked about that. That's kind of been a theme, a recurring theme since 2023, since the Fed really started to raise rates in 22 and kind of got to the point that they thought was restrictive enough, and higher for longer seems to be a recurring theme. It has not come down, I don't think, as much as other people had hoped or investors had hoped.
No, and I think that tells the stock market, hey, listen, if you were counting on lower rates this year, you might want to rethink that position. And I think that's going to require the market to reevaluate their prospects for any Fed help anyway, which is interesting because even though that's the case this week, the stock market, at least the Dow, the Nasdaq and the S&P, if today's Friday, it's 2:30 before the market closes. Today, the Nasdaq and the S&P are pretty close to all-time highs. Pretty close, not quite exactly at the all-time highs, but pretty damn close. And then the Dow is not that far off either. So even though the market knows, or at least I think they got the message that you can't count on the Fed to help you out later this year, the market's still powering through.
Yes.
And I think that all goes back to earnings.
Yes. And so what is driving that recovery? And it's really strong Q1 earnings, like you just mentioned, Gilbert, and the growing hope that the Iran-US negotiations may be progressing. That, along with strong earnings, is help bolstering this and prop up this rally. So the S&P 500 Q1 earnings growth now tracking close to 27.8%, fastest pace since Q4 of 2021 per LSEG data. Iranian state media reported Thursday that Tehran sent its latest peace proposal through Pakistani mediators. Oil fell nearly 2% earlier today on that report. Brent pulling back towards 110 from 118 earlier this week. And December crude futures are still around the $80 level. But yeah, stock market's still close to all-time highs, even with all this geopolitical stuff backdrop and all the Fed things that we just mentioned. So let's talk a little bit about GDP and inflation, then we'll move right along. So Q1 2026 GDP advanced estimate was 2.0% annualized. It's a meaningful recovery from Q4 revised 0.5%. It came in below the 2.3% economist consensus estimated. The main contributors were AI equipment investment, exports, consumer spending, and government spending. Investment in computers and AI data center infrastructure was a standout driver of GDP. Consumer spending decelerated. Households tapped savings to maintain outlays as energy prices rose. Personal savings rates declined, a yellow flag for the durability of the consumer-led growth. And that's the other thing that we've been talking about for the last several years, is that the consumer has remained strong too and remained resilient, even in the face of all this inflation that's kicked up since, post-COVID and during the time that the Fed's been hiking rates. I mentioned inflation earlier. It is the PCE metric is the one that we got this past week. That's the one that the Fed prefers to watch versus CPI. CPI is consumer price index, and the PCE is personal consumption expenditures. And they really prefer to watch core PCE. So that strips out the volatile food and energy costs and just looks at the mainly services and shelter costs. Core PCE rose 4.3% versus the 2.7% in Q4, so up substantially. That's the highest number we've seen in quite some time. It's kind of reminds me of what we were watching in 2022 when it was like the inflation reports was what was driving the reaction in the markets, and it just couldn't wait for the next inflation report to come out because we all knew we were going up, and then we couldn't wait for it to top out. And so I feel like this is a little bit reminiscent of that. All right, so let's talk a little bit about earnings. The big tech guys are the ones that really reported this week. They were the ones that were under the microscope. Alphabet, Amazon, Meta, Microsoft. They all beat Q1 earnings expectations, and they all reported Wednesday night. Alphabet surged. Google Cloud revenue reassured investors that AI spending is translating into real revenue growth. That's been a long time concern for the hyperscalers, if you will. Amazon gained after hours. AWS growth remains strong. Of course, that's Amazon Web Services, which is a big part of Amazon's business. Meta fell. Concerns the company is overspending on AI capex relative to near-term revenue payoff. So they're worried. Once again, it's like another ROI story of the capex spend. Microsoft fell slightly despite beating estimates. Azure guidance and AI monetization timeline raised questions. Combined 2026 AI capex guidance across all four companies exceeds $600 billion.
That's it.
Yeah, that's quite the capex number. But that's also another story that the markets and investors have been watching closely. We know that that's a big component of these hyperscalers and what they have going on there, and the overall AI story. Apple jumped more than 4% Friday after its fiscal Q2 earnings beat. The iPhone 17 and MacBook Neo demand drove solid results. Company guided for strong Q3 revenue growth. iPhone revenue fell short of estimates for the second time in 3 quarters, but guidance overshadowed the miss. Apple also reported robust performance in China, a market many investors had kind of written off. And then Spirit Airlines. Over-the-counter shares fell more than 62% Friday after the Wall Street Journal reported the carrier is preparing to liquidate its fleet and shut down entirely. I do believe they were in talks with about a possible some kind of bailout. I don't think that went through. So, unfortunately for Spirit, that negotiation did not work. It was a $500 million government rescue package, and they were unable to secure bondholder support.
They will exist only in spirit after this.
That was good. Yes, that was great. And
I kind of just walked into that one. It was, yeah.
Well,
I'm not that witty.
Well, and it's just, I think it's also a subtle reminder that not every story this week is a winner, right?
That's right.
So there are constant fluxes in the market, and you don't necessarily see all of them or get a good picture of them at any point in time because of headlines pinpointing certain events or certain things. All right, so key takeaways: the S&P 500, Nasdaq hitting all-time highs this week. It's a reminder that markets look forward 6 to 12 months, not backwards. Even with oil elevated, inflation hot, and a divided Fed, a strong earnings season and signs of Iran diplomacy were enough to push stocks to records. The 8-4 Fed vote split that we talked about is the most important signal from this week, like you talked about, Gilbert, that most people will probably overlook. When the Fed is that divided, policy uncertainty is real. 3 members want to remove the possibility of future cuts entirely. That tells you inflation concerns are serious even inside the building. PCE inflation at 4.5% in Q1 is the hardest number to ignore this week. That's more than double the Fed's 2% target. We talk about their dual mandate on here regularly. They want, price stability, which is about 2% inflation target, and full unemployment, which they reason to be about 4% on the unemployment rate. If energy prices stay elevated through Q2, the next PCE reading could be just as challenging. We all kind of know that story. That's kind of why we're following oil markets. This is the number that keeps the Fed on hold. And I think that is true for sure, that if oil prices remain elevated, interest rates are likely to remain higher for longer. Q1 GDP at 2% is the better news this week than the prior quarter's 0.5%, but the the deceleration in consumer spending and the decline in the personal savings rate are worth watching. I think those are noteworthy items as well. Households are spending but dipping into savings to do it. That is not a sustainable pattern indefinitely. Jerome Powell staying on the Fed board matters more than I think most investors realize. It means Trump cannot immediately stack the board with 3 appointees. Institutional stability at the Fed, even as a leadership transitions, is a meaningful check on the policy volatility that would otherwise price in. If you've been sitting on cash waiting for the right moment to invest, this week is a reminder, I think, that timing the market is extremely difficult. The best monthly gain since 2020 came during the most active Middle East conflict, a divided Fed, and the above target inflation. Discipline and consistency beat prediction. We talk about it all the time on here. Time in the market beats timing the market. And I think the month of April is a good reminder, with the S&P up something like 10% on the month, and the Nasdaq up 15% on the month. Those are huge numbers. And the best one in 5-6 years, month number. I mean, that's impressive. That's something to pay attention to. And it just goes to show that no matter what you think the vibe is of markets, and no matter how daunting things might seem, the market can surprise you.
One thing that kind of we moved by as a side note was the one Fed governor voting to cut rates because of growth concerns, not because he thinks inflation is under control yet. So that kind of tells me that the boogeyman is still in the closet and stagflation fears are still there, even inside the Fed. And he's the only one who spoke on it, but I'd be willing to bet there's more than one person who still sees growth problems coming up.
Yeah.
And I think that speaks to the time we're in. There's a lot of moving parts. There's a lot of uncertainty. So now is a better time than ever to come speak to a financial advisor. And we can't build you a bulletproof plan that'll weather everything, but we can build you something that fits you and it's suitable and it'll weather the storms. You kind of said inflation, it was reminiscent of the time when inflation was the hot thing and every single inflation report was the thing to be looking at. And I feel like we would still be somewhat in that boat if we just didn't have so many moving parts elsewhere, with Iran.
Yeah,
that
the geopolitical
takes
stuff.
The headline now, and inflation's in the back seat, but it's still there.
What to watch next week? All right, we got some economic data coming out. We have CPI on May 12th. That's coming pretty soon. There's going to be some services and manufacturing data that comes out next week, and of course, we have the jobs report and non-farm payrolls on May 8th. So there's going to be some economic data coming out. And to your point, Zach, unemployment growth concerns, those things sometimes go hand in hand. So markets will be watching that. And of course, the ongoing Iran-US peace negotiations and any developments there. So record highs on the S&P 500 and the Nasdaq. Powell's final press conference, 34-year record for Fed dissent, Apple blowout earnings, Q1 GDP recovery, and PCE and inflation running at 4.5%. This was one of the most consequential weeks so far in 2026, and the market is not finished, even though it did finish at close to all-time highs this week. That tells you something about the resilience of the economy and the earnings engine underneath all of the noise that's out there. Stay invested, stay informed, and we'll be back next week with the April's job report and the next chapter of Iran negotiations. Thank you very much for listening. We will catch you back here next time. Have a great weekend. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.